Good evening, everyone. Welcome to Crypto Pulse Weekly. Good evening on Instagram. Good evening on Zoom.
Good evening, Doc.
How are you? Yes, let's get started. Um, Welcome to Crypto Pulse Weekly. It's been a it's been a very eventful week in the world of crypto, as you can imagine. The two biggest bank, really, uh, uh, in the crypto sector are, are getting liquidated. Let me use that word. So the first was Silvergate. Silvergate was like the shadow bank, or you could call them a shadow bank, but they were basically the company within the United States that provided an off-ramp infrastructure for crypto. And by saying that, I mean that they were the banks that you could go to get your crypto converted into fiat currency at an institutional level. So many of the exchanges would usually piggyback on them, and then are able to have their transactions within the United States. But apparently, Silvergate is one way or the other connected to FTX. I'm just hearing about Silicon Valley Bank today. They're much more robust. I mean, Silicon Valley Bank was about $180 billion in market cap, so they're much more bigger bank than Silvergate. And I would have thought that they were too good to they were too good to fail, or they were too big to fail. Well, apparently not. So, two thoughts on these crypto banks. One is that there's a systemic onslaught against crypto infrastructure in the United States, and I've always said this. By the way, I've always said that it does not favor the US dollar to have a seamless crypto off and on ramp, because it means people can wake up one day and make a run on the US dollar and move all the value into cryptocurrencies. So it doesn't favor them. By them, I mean the owners of the US dollar, wherever they may be. What's wrong with my? There's something wrong with my live stream today. The owners of US dollar, whoever they may be, there is okay. Please give me a second. I need to disconnect my phone. Yeah, that should be fine. Okay, should be good now. Yeah, it should be better now. So, well, as I was saying, it doesn't favor the proponents of the US dollar, and as a result, I think there's a systemic onslaught against um, cryptocurrency infrastructures, and these are the two biggest banks in the United States that provide that off ramp and on ramp infrastructure for cryptocurrencies. And to be honest, I don't think the bear market is as severe as to them for as for them going under. There are many banks that have bigger market cap and have not gone under. I mean, they've been bailed out. For instance, during the financial crisis of 2008, most of the banks were in a similar situation to Lehman Brothers. The only difference was they still had a few more months ahead before they imploded, before they got bailed out. So really and truly, I would have thought it was a big deal. But understandably, because these banks particularly are associated with cryptocurrencies and crypto exchanges and all that, it looks like they're probably going to allow them to fail so that they can turn around and say, "We told you so. This thing is not working, and we need more regulation." Blah 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 blah. But like I said, that story of regulation is going to lead us to a CBDC innuendo, meaning we're going to end up with digital bank currencies, digital US dollar. But the difference between the normal US dollar that you have today and the digital US dollar is that digital US dollar is 100% controlled essentially by the United States government. That's what it means. The US dollar today, once you print it out from the US Treasury or the Mint, wherever they print it, and you ship it out, that's it. The only record that exists are the serial numbers that have been printed and the ones that have not been printed. That's the only thing that exists. Um, if, for instance, somebody stole the machine, or the manufacturer cloned the machine and replicated it, you will not be able to tell, because if you created an original version of the clone, I mean, an original clone, as it were, that will pass through verification. Which the only difference is if you have similar serial numbers, and you won't be able to check that if you don't have the two notes side by side. So what I'm saying is the current state of the US dollar being a paper currency allows for a lot of loopholes. But with the creation of a central bank digital currency, especially for the United States dollar, it means that the United States has ultimate control on the monetary system of the world. I don't think that's going to happen quickly, because one of the pushback they're going to have is people like Russia are not going to agree to use their CBDC. I think the same is going to happen to China. China is going to say, you know what, come and use our CBDC instead. So I think there'll be some pushbacks, and I think I think the International Bank of Settlements will try to broker will try to broker a peace deal on uh, this and probably offer like a settlement house, if you will, in which case they will act like a centralized exchange where you can convert your USDC or US dollar um, digital currency to Chinese digital currency. But at the minimum, there will be three. There will be the European one, there will be the US dollar one, and there will be the Chinese one. Whoever launches first is going to trigger the other two. There could actually be four. There could be the pounds one as well. But what it then means is that the government has 100% control on money flow. In fact, not only that, they determine how you can spend your money because they can decide that we're going to block your wallets. You are spending too much money on chips. As a result of that, we think you are going to incur a lot of healthcare costs. So we are blocking your wallets, or your carbon credit is not enough. So we're going to block your wallets and not allow you to spend until your carbon credit comes back to normal or comes below the threshold. It sounds like joke, right? But that's what's going to happen. That's what's going to happen in a few years or a few decades time. There is already just for your information, there is already a report by the World Economic Forum of a simulation of a cyber world war crippling the internet. Now, the reason I brought it up is World Economic Forum is notorious for carrying out simulation and then the simulations come to pass. Don't ask me how, but the simulations come to pass. They carried out the simulation for a global pandemic in 2000 and in fact that simulation finished in July 2019 and what followed was the COVID pandemic. So I do not take their simulations or I do not take their reports with levity because the people that congregating in those forums have a lot of power and deep-seated pockets to make sure things happen on the earth or on the world that they want to happen. So if they're talking about a WW3 scenario where there is a global outage because of a global cyber attacks, I know that definitely they're in the works. So I'm just saying that so you understand that there are forces of evil and forces of good on the earth that are trying to achieve different aims. Once the US dollar goes digital, almost all the other currencies will go digital. Banks will turn to more or less like exchanges, helping people to be able to navigate between one country's digital currency and the other's digital currency. Because the US dollar is still in control of the petrodollar, they will want everybody to, defer to them. But I foresee a situation where there'll be a lot of alternates, like we call it today, altcoins. There'll be a lot of alternate to the US CBDC, and the ones I can see in the offering are the the digital pounds, the Chinese digital yuan, which is already in place. They call it a different name. It's already in place. It's just that people are not using it as such. The European one, definitely, and we will see a major attack. I mean, we're already seeing attacks on the major exchanges. So yeah, how do you keep your coins? Very straightforward. Um, if you are technological savvy, I would say yes, you can keep your coins in decentralized wallets. There are a lot of decentralized wallets. So to explain this question, actually, how do we protect? What do we do, and how do we protect our tokens or coins? So this question takes me to a short lecture in the technological basis of crypto custody because I need to explain that to explain what you need to do. Cryptocurrencies are literally internet money. Think of them as pieces of codes like addresses on the internet. So, or think of them like the pieces of data that you carry in your email. So, for instance, if I sent you an email now, that email is probably like 36 bytes or 126 bytes or kilobytes. If I put an attachment, it's probably like 1 meg. or 2 megabytes. Now, think of cryptocurrency as those pieces of data that's been sent across your emails, and think of your wallets as the email addresses. They are actually addresses, but think of it that way. That's the closest analogy I can give. Now, centralized wallets are like your electronic banks, which are like the Binance, the KuCoins, the Coinbase of this world. They're like electronic banks that have a central database. Many of them have different structure. FTX structure was just a fraud, but most of them usually have a central database in which they're able to aggregate people's funds and then allocate wallets to people, what we call hot wallets. They allocate hot wallets to people at a database application level. I don't want to go into technicalities of it, but it's just like electronic banking. The way your electronic banking is pretty much the way most exchanges work in how they organize the funds of customers. Now, there are two levels for each customer that a centralized exchange has. One is your record of funds within the exchange, and then your record of funds that goes out of the exchange or comes into the exchange from outside wallets. So let's take Binance for example. Binance, for my account in Binance, for instance, each of cryptocurrency that I have there, there is a wallet for it. Usually, apart from Bitcoin and yeah, apart from Bitcoin, Ethereum, and BNB, most of them will fall under that category because most of the tokens will fall on each of those, either of those blockchains. So usually the address format, or the what you call the wallet address, the OX with the multiple numbers and digits, is like an email or a website. It's like an email address within the main wallet. So how do I say this without confusing people? The the main wallet that you have with the exchange is a database record that works like the electronic bank. Then you have a blockchain record. That blockchain record essentially is a wallet address that is given to you by the exchange on the respective blockchain. I'll take that again. The main wallet that you have with an exchange is a database record that works like electronic banking. The blockchain wallet that you have with the exchange is an address on that specific blockchain that's been allocated to you by the exchange. So that address is for proper exchanges, by the way. That address is actually an address on the blockchain. You can check that address on the blockchain and you will see that, okay, this is the movement in and out of this address. Let's say it's an Ethereum address. You see that there's a movement in and out of that address for you on the blockchain. There are some exchanges that have pools of wallets. So what they do is they have their own, let's say 50 or 100 wallets where they collect funds into per coin. Then they route it to your own wallet with them, which is like the database entry that I was talking about. And then if you now need to move funds out, your fund will first go through their own wallet and then go to the destination wallet that you want it to go to. Why did I need to explain that? I need to explain that to explain decentralized wallet. So decentralized wallet, on the other hand, are addresses that can be created with specific applications. Now, these addresses is like creating an email address for yourself. So when you do that, it's assigned to you. You have access to that address. Now, that money in the real sense of it, or that crypto, never really leaves the blockchain in the real sense of it. But for that crypto to move from that address to another address, it has layers of security. And that is where your money, or what's it called? Not your, not your, what's it called now? Not your address, not your something like that. Not your wallet, not your money, something like that. But the concept is that,
Not your key.
thank you, not your key, not your not your key, not your money. The concept is that that key is what gives you access to that wallet to move funds out of that wallet. Now, without that key, you can't move funds out of the wallet. So it's generally accepted that if you can't move funds out of the wallet, it's not your money. So, in as much as the bull run is expected to kick off latest by Q2 next year, if you are a long-term investor, you might do well to keep your coins and your tokens in decentralized wallets. Now, decentralized wallets for the most part are just software applications that create, I don't want to speak too much technical speak now. Think about decentralized wallets as email engines. They allow you to create emails. Now, don't forget our analogy of email and wallets. They allow you to create an address using the application on the blockchain. So essentially, what the wallets do is the wallets are like mega nodes. Let me use that word. Nodes are like computers or mega computers that connect to a blockchain. So those wallets are like mega nodes that allow you to create an address. Now, when they allow you to create an address, what they're doing is they're giving you a sub node using that application. The good thing about this is that the the whole process is encrypted. So even though they are the one that are allocating it to you, because once you take the application to create the node, it creates the node, the sub node, which is your wallet address, and assigns it to you. Now, there and then you get the pass keys, the passwords, and all that stuff. Nobody else is able to access those security parameters except yourself, and that's why they say don't lose your keys. Write it down, keep it somewhere. Don't take pictures of it. Don't upload it online so that nobody sees it. And once anybody sees the parameters, they can move your money. So those decentralized applications or decentralized wallets like Trust Wallets, Coinbase Wallet, Crypto.com Wallet, SafePal, MetaMask, what am I forgetting now? I mentioned Trust Wallet, MetaMask, my Ethereum wallet. Yeah, those are the ones I wanted, top 6 I wanted to remember. Now, these are decentralized wallets that allow you to do what I just explained. So they allow you to create subnodes using your phone, your desktop, or your tablet, anything that can connect to the internet.
You also have Coinomi wallet.
Yes. So these applications allow you to create subnodes, which are the wallet addresses. So the same way Yahoo will allow you to create Yahoo Mail for yourself, the same way Google will allow you to create Google Mail for yourself. The only difference is that the process of the security authorization that you set up is only visible to you. Yeah, same thing with Coinbase Wallet. Now, somebody says, what about cold wallets? Yes, so cold wallets is the same. The same underlying principle works for cold wallets. The only difference here is that let's take cold wallets like Ledger, or what's the name of this other one? Funny enough, I had
Trezor.
Trezor. I had the wallet somewhere around. So Trezor and Ledger are very good examples of cold wallets. What's a cold wallet? Same principle. The only difference is that the cold wallet adds an additional layer of authorization. What do I mean? Or security. What do I mean? So just like Coinbase Wallet or my Ethereum wallet or Trust Wallet has the the security key, the passphrase, all of that stuff that allows you to access the wallet. The hardware wallets, as we call them, also has the same thing. So each hardware wallet requires you to first install the application on that wallet. So if you buy a Ledger wallet, for instance, it will ask you for which applications you want to install. So for you to put Bitcoin on it, you have to install Bitcoin application. For you to put Ethereum on it, you have to install Ethereum application. When you are installing the application, what you are doing is you are creating a sub node. Because the wallet provider will have set up as a node on that blockchain, it allows you to connect. So for Ledger, for instance, they have a series of blockchains that they provide services for. What it means is that for each of those blockchains, they have a node or a massive computer or a set of servers that are connected to that blockchain. So what then happens is when you make a demand, let's say for the cold wallet to install the application, what you are doing is you are creating a wallet address for yourself on that external drive. Now, when you create the wallet, it generates an address. When it generates an address, that address becomes a subnode or an entity on that particular blockchain. So let's take Ethereum and ledger, for instance, which is very simple. When you buy a fresh ledger, it will ask you, the ledger will ask you to create a password. So ledger itself will ask you to create a password. Then it will ask you to create a PIN. That's the ledger, the physical device. Now, when you create the PIN and you plug it, so for that ledger to work, you need to plug it to a computer or a device. When you plug it to a device, it will ask for the Ledger app on that device. If you don't have, it will ask you to download. When you download the Ledger app, or you ask you to connect to the Ledger website, it works either way. The app is just like a web page. So when you connect to it, what it then does is that it gives you the list of the services, which are the list of the blockchains that Ledger can connect to. So it asks you to download the applications. When you download the applications, it assigns you an address. The address that assigns you becomes available on the blockchain, and anybody can send funds to that address. It's now your address. However, for you to move money out of that address, you need access to all the things that have been set up. So let's say I move 10 Ethereum to that address, and then I close the application on my laptop and I remove the physical hardware. What it means is that nobody is going to be able to move that money except they know my passphrase. So as I plug that, so let me give you let me give you the layers of security. Two layers of security are available on the ledger itself: the passphrase and the passcode or the PIN. It will ask you for both of them. So if you don't remember any one of them, then we don't even have access. However, it will also ask you to write down the passphrase. The passphrase is usually like 12 or 24 words in the specific order. Now, those passphrases are the keys that we'll talk about, because if you don't remember those passphrases, you cannot retrieve that wallet. If you lose the passphrase, if anybody picks it up, that person can reactivate your wallet on their device or on wherever and move the money. So Ledger itself will ask you to write down the passphrase for for the device that you've plugged in. And once you kept the passphrase, it will also ask you for an online, whether you want to create an online password, meaning you want to create a password for the Ledger application on your device, so that if you perchance anybody logs on your system and sees your whatever and sees your ledger, they can't just try to move stuff. They will have to go through the password on that ledger application, the PIN on your ledger device, and the password on your ledger device for them to be able to carry out any transactions. So it's important that you know this, because in times to come, I think centralized exchanges will be under severe attacks by the government and government entities, because it doesn't pan well for fiat currencies, for cryptocurrencies like Bitcoin and Ethereum to continue to exist. And I don't know if, and I've said it a number of times, but just to explain why. Monetary policy or monetary control is one of the strongest elements of control that the modern day government has over its citizens. If the government cannot exercise monetary control, then there's problem. The only reason why US is where they are is because they are in charge of the monetary control of the world, literally. And that's why the country has been so strong and so prominent in global politics and almost everything, because we are all spending the US dollar. If everybody woke up tomorrow and say we're not spending the US dollar again, there will be trouble. There will be problem, big problem for the United States. So to make sure that nobody is going to wake up and do that, the United States has a formidable army that makes sure that if you don't want to keep in line, they will keep you in line by force. So understanding the concept of decentralization and why there was something like Bitcoin to start with is very critical to how you go about, storing these things. So what can you do apart from getting a decentralized wallet and storing your keys, writing down your passphrase? You can write it down in books. You can write it down and keep it in a safe place. If you are going to put it on the no, I don't want. Let me not talk about putting on the computer. It's not advisable best practice to put your passphrase on the computer. as a technologist person, I know some things to do, but I don't think it's safe for everyone to do so. So it's better to write it out. You might write copies of it and keep it, in secure places. Just like the what's it called? The founder of or one of the founders of Ethereum, the main founders of Ethereum blockchain, Vitalik, he says that he has one of his keys, no, half of his keys in Canada, half in the US, no, a third in Canada, a third in the US, and a third in his house in Dubai or something like that. So even if you cut him, you are never going to be able to get his Ethereum stash off him. So it's important that if you're considering keeping significant amounts of assets in crypto, uh, take time to learn how to safeguard your wallets. That's one thing. And will the bear market continue? I think we're going to see a number of onslaughts, probably till the end of the quarter. Now that you have two major banks supporting crypto going down, it doesn't mean that crypto is going to go down. It just means that the government wants to dip their claws more into the sector. By the way, when you see Bitcoin going down, like you can see, so ES1 is CME mini features, which is a direct representation of the S&P 500. Let me put it there so you can see. What time frame was that? That was the daily. Yeah, let me put this on the daily so that you can see what I mean. So you can see it's almost the same similar charts. Now, S&P 500 has been coming down for literally the last 5 days, practically because the US dollar has refused to weaken. Literally, it has refused to weaken. You saw non-farm payroll came today. It was good figures. What's it called? Came out on Wednesday. It was good figures. So really, there is no basis for the dollar to calm down, quote and unquote. And what that means is that the central bankers will continue to try and make the dollar calm down by increasing interest rates. Increasing interest rates usually hurts the economy. So what they're trying to do is to hurt the economy to bring down inflation. That's what they're trying to do. I'm not an economist, but that's what they say is their best tool, and that's their day job. So I can't question I can't question them on the basis of their judgment for their day job. But that's what they say, that they need to keep inflation in control, even though the economy has refused to calm down. So what has happened is a lot of money has been pumped into circulation, like I said before, during COVID. That money is still in circulation. They don't know what to do with it because it's causing inflation. So to make that inflation go down by force, they're increasing interest rates. However, the unintended consequences of increasing interest rates is that most companies that run in today's world run on leverage, meaning they run on debt. So, and it's not just running on debt, they are leveraged to their degree of debt. So, debt versus the amount of equity they have is how much they leverage. Just like you talk in trading to say 1 to 10 or 1 to 5 or 1 to 20. So, they are leveraged to the degree of their equity. So, I'm not surprised, for instance, that companies like Silvergate and Silicon Valley Bank are suffering because the crypto market has been suffering for over a year already. So it means no revenue or very low revenue. Meanwhile, there are debts that they might have been servicing. I'm just trying to hypothesize what might have gone wrong on the balance sheet or the financial statement of those companies. There are debts that they are servicing, and those debts, they were servicing them at low rates. Now that Fed has been increasing rates little by little, what it means is some of them might not be able to pay the rates on those debts, or they might be failing to meet up with the escalating rates, because as the federal banks increase the rate, the lenders, which is the bank, they in turn apply the rates. It's just like it's just like say somebody puts fire under your bomb bomb, or you put fire under somebody else's bomb bomb. That's exactly what they are doing with this rate hike. So the rate hike has an unintended consequences of affecting the equities market, because what it means is companies that are running on loans now need to pay more interest on their loans. If they're unlucky and their revenue is not matching up to the level of interest that they have to pay, they will have to file for insolvency. If they want to play smart and get out of the loan and liquidate the company, they will file for bankruptcy. Filing for bankruptcy means they're not going to pay the loan, so it's going to be written off. There will be consequences, of course, but it saves the company. So usually, I don't, I don't like to talk about this because it's one of those untold secret of how how organizations screw people up, especially banks. Usually, a bank is able to operate based on, for instance, how much cash he has as customers deposit versus how much he can borrow. So if he's borrowed out a lot, uh, both for customers and not for its own operation, and then the interest rate goes up, two things happen. One, the bank now has to pay more for its own loans that are organizational loans. Two, it has to force its customers to pay more for the loans they've taken from the bank, credit card loans, mortgage, car loans, all sorts of loans. So when that begins to trickle down, then two things can either happen. One is the people that are taking the loan default on their loans, creating a backlog of problem for the bank on how they're going to service their own loans, or they all together have to declare bankruptcy. And if they declare bankruptcy, then and there's a huge number of them, there's a bankruptcy pile up. So that's the that's the domino effect of increasing interest rate, because eventually it starts to affect the availability of funds and the cost of capital. I'm beginning to talk like an economist. I'm sorry. But basically, what I'm saying is it costs money for companies to run their operations. So they take loans from bank to run the operations and ensures that things like salaries are paid, rent, and all that stuff. They are meeting the running cost of the organization while they are carrying out the activity to make money. The agreement is that when they make the money, they will pay back. The problem now is they borrowed, let's say they borrowed at 0.1, or let's say that they borrowed at 1% when interest rate was zero in the United States. Now they have to pay back because interest rate has now gone from zero to wherever. It has gone more than one basis point, 100 basis point. That's gone more than 1% from the central bank. Bear in mind that the rate that the central bank announces is the base rate. On top of that rate is what the banks build their rate. The banks, the lenders, everybody will now build their own markup rates on top of that. So let's say the company took the loan at 2%, which was 100% of what the base rate was. Now base rate is 2%. They now need to pay 4% or 5% because their lenders have increased the rate as well. Of course, it's a problem because if the company is not making that much money, they now have a problem because they're not able to meet their obligations. And if it continues and persists for a while and the company is not able to raise funds, the company is going to file for bankruptcy. So that's exactly what's happening. Um, if we are to technically dissect the Silvergate and the Silicon Valley problem, that's exactly what happens. It happens with all companies. Most big companies, for the most part, are running on leverage. Now, how you steer that leverage and manage that leverage is dependent on the skill of the CFOs and the kind of accountants that they have, and strategic managers, or what they call them now. Yeah, CFOs or investment bankers that they have that's able to steer them in the right direction and you know keep the books looking good without exposure, as they call it. So if the exposure goes too much, then they can't afford it, and that's why companies file for bankruptcy, because then it means that the amount of loans is way too much, or the interest on the loan, not even the amount of loan, the interest of the loan is way too much for the revenue that the company is making. So for most organizations, they can have loans running into decades, multi-decade loans, um, or line of credits that is based on interest rates, and they might have been fine if there was no interest rates hike. But now that there's interest rates high, cost of capital is at least 100% higher at the minimum. So it's a big problem. It's not going to go away until the economy simmers a bit. So even though people are expecting that there was going to be recession, even in UK, the recession didn't happen. Again, it didn't happen. Same thing with US. So I think, oh, now recession is going to come. Recession didn't happen like they were expecting it, because the job figures are high. The economy is still raring to go. So they'll probably, like I said in the sessions last year, they'll probably keep applying the rates probably to the end of the year, or Yeah, probably to the end of the year or probably end of Q3. And until they stop, there is no respite for equities market, and obviously, it means there is no respite for our dear crypto markets. Um, how does that affect Bitcoin? Yeah, I think things stay the same. Let's have a look at the chart before we close out for the day. So I was talking about this scenario about 2 weeks. No, that was last week. And the scenario was that the weekly chart was not looking good. Yeah, let me expand it a bit so that let me see if it's able to. Yeah, let me expand it so that it's a lot more visible on the. Still not visible. I find out that this the charts don't show well on YouTube. So yeah, let me put it this way. So this is the weekly chart that shows the downward trajectory of Bitcoin so far. And based on that, I said that I expected Bitcoin to go as low as 11,000 or 10,005. And the reason I said that was because I think I said that somewhere around here. Then the market rallied and then came back. So this was November last year. As at the time, I thought it was just going to come down all the way, and this is a trend line that shows the market coming down all the way. But instead of coming down all the way, it broke that trend line into what you call a sideways consolidation, meaning instead of going all the way down, it broke into a sideways consolidation. And now, at the weekly level, let me use this marker to trade. At the weekly level, it is more or less ranging between the 25,000 range uh, and the 15,000 range. Based on some time-based technical analysis, we're still likely to see. I mean, it's obvious from what I'm seeing on the chart now. The next 2 weeks are going to be bloody. No matter how much the market pumps, yes, the next 2 weeks, especially next week. And let me explain. Let me explain why. There's something called candlestick patterns, and that's why what you can see on this chart. These are Japanese candlesticks. It's been invented a long time ago. Long story, but basically, it clearly demonstrates market sentiment at a very higher time frame. Clearly, it does not miss. When you're looking at it on a higher time frame, it's like looking at pardon me, it's like looking at Ifa Oracle. It's like looking at the Oracle because it's it's almost inevitable. So if we look back here now in retrospect, what we have here back in October of 2021 was a candlestick pattern known as bearish engulfing, meaning the week, the previous week closed at a much more lower rate than the week before it, swallowing up all the size of the body of the candle. So this is the body of the candle. These are the wicks. This is the body of the second candle. These are the wicks at the top and the bottom. So the body of the candle of the week of 15th of November completely swallowed that one of 8th of November. Completely. Like, in fact, it's almost like times 3 of his body's length. And then the previous week, of course, the previous week did not succeed in shooting back up. Automatically, he nailed the top for the bull run. Unfortunately, of course, it was a foreboding of things to come because we saw that it went all the way here, and then here again you have the same thing. This spinning top candle met by a very long candle down again. Same thing happened. It went all the way down. Same thing here. Another bearish engulfing. It came all the way down. So here is a bit different. This one they call it three whites. Is it three black soldiers or three white soldiers? I can't remember. but it's a situation where you have downward candle, three downward candles following themselves consecutively. It's a sure bearish pattern, very sure, especially when the one before it was a push to the upside. So essentially, the market has topped out at 25,500 essentially for the past 4 weeks. And now we have what you can call a variation, meaning a change in market direction. And you can see that if you count from here, one, two, three, four, these three candles, the summation of these three candles have completely enveloped the candle of the 13th of February. In other words, I was saying I was waiting for this week. Last week, I was saying that I was waiting to see what this week looks like because this already was looking to me like a variation in making. This price level, which is 19,940 right now, confirms to me that the variation is in place. So what does that mean? What it means is that Bitcoin is going back to 15,000 unless something drastic happens in the next 2 weeks. I think Bitcoin is going back to attempt that level, at least 17,000. That's my personal projection. Depending on what happens here, we might eventually see that 10,000 we're talking about before. We might eventually see that 10,005 or 11,000, depending on what happens here at the 16,000, 15,000 level. But for now, I think we're headed down, at least for the next 2 weeks. My bets will be 17,000 end of next week at the minimum. That's if we've not dipped into 15,000 before then. And the reason, of course, there are other what you can say complementary factors. One of the complementary factors is you see this trend line coming all the way down. Let me stretch this a bit. That trend line was supposed to provide like a restriction for the price to break out, but the price broke out and didn't really go up. So it's not gone up now. Instead of going up, it's gone and done what you can call a double top. One here, one here. When you have a double top, price is going to go to the bottom of the formation. This is the bottom of the formation, which is 16,000. Automatically, what it means is that before we see any recovery, significant recovery in the price of Bitcoin, I can categorically say that we will see 15,000. Like I said, if 15,000 or 16,000 holds very strongly, then maybe then the price might try to continue in range. In which case, let me give you this scenario. ABC, in this case, it will be like something like this. So, if I know, let me look for the other one. It's ABC. So it will be something like this. So something like that, and before it attempts to go back to 30K. That's the way I see. That's the way I see the price of Bitcoin playing out. So if like I said, dollar cost averaging is still the best strategy in this scenario. But if you set aside money to buy Bitcoin this month, I would say you wait for the next 1.5 weeks at the minimum to see how this pans out. At the minimum, wait till the end of next week or beginning of the upper week, because it looks like we need to revisit that. We need to revisit that range. I'm not saying that Bitcoin is going to 10K immediately. What I'm saying is definitely going to revisit this bottom range, which is currently about 15,700. So if it gets there and we get a strong rebound, happy days. Then we know that 25,000 is the next target again for some time being. So that's the synopsis of the analysis for now. Ethereum is not going to be different because he needs to follow his older brother, as they say. His older brother is not doing well, so you can see Ethereum's pattern is even funny because this is now forming what you call a falling wedge. Oh no, not a falling wedge, a bear flag. Sorry. So the chart pattern is called bear flag or bull flag, depending on which direction the market has been coming. If the market has been going up, this will have been a bull flag, but the market has been coming down, so this is a bear flag. And usually, what this means in chart analysis is that, and I'm using the weekly chart because the weekly chart is the most reliable. You can't fake it. That's the true picture of the market. Um, Usually, when you have a pattern like this, like a bearish flag, the measured move down is usually the length of the market or the price before the chart. So just to apply that directly to what we're seeing right now, it means that this guy can go as low as here. No, that will be from here. So can go as low as 195. I didn't make the rules, but that's the way it appears. So my original intent was to wait for Ethereum at $500. I think I'm still gonna wait for Ethereum at $500 because this for sure is a bear flag for sure, and there's no two way around it. Yeah, there's no two way around it. It's not looking good for Ethereum. If it's not looking good for Bitcoin, of course, Ethereum is gonna suffer. Yeah, yeah. I think it confirms my hypothesis. By the way, I purposely don't look at this chart before coming on online so that I can look at it from a very objective objective view. So I usually am not studying the chart before, especially the long term chart. I don't usually study them before going live. This is the last bastion of hope for Ethereum, 1,357, and it's already tapping on it. It's already tapping. It's already tapped on it this week. And with what we have now, the same you can see it's the same setup with really. It's the same setup with Bitcoin. It has a bullish candle, then three bearish candle. Three bearish candles back to back is a bear flag, is a bear signal. Any day, anytime is a completely bear signal. So yeah, Ethereum is not it's not going to look good for a while, to be honest. Because if and when Bitcoin picks up, then it's going to tilt the balance of what you call Bitcoin dominance and make sure that all the altcoins suffer first when Bitcoin is still gathering strength before they catch up later. So Ethereum will make you more money than Bitcoin, of course, in the next 24 months. But I would wait. I would wait for Ethereum at $500, like I said. $500 is floor level. It's floor level at the weekly level chart. It's $500 is floor. And what it means is the market should have been exhausted. The price action should have been exhausted at that level. So if it gets to four, I mean, you might get lower than that, but buying Ethereum at 500 and selling it at 5,000 is not a bad idea. So I think Ethereum is going to 500. I think this this pattern I think confirms my original bias. Honestly, let me check something. Confirm, confirm. It's going to 500. I don't know when, but there are too many constellation of how do I put it now? There's too many constellation of patterns that confirms that yeah, it's not looking good for Ethereum. It's worse for Ethereum actually than Bitcoin. You just going by these charts. So what can you do? Yeah, just have it. You can have a pending on that. You can have if you. I mean, I still believe in it. I still believe Binance is solvent. It'll probably be solvent till the end of next bull run. So we can use Binance. We can use what's it called? Oh, crypto.com. Crypto.com is still around as well. In fact, I think the crypto.com app now has it has that spending order functionality where you can set the price at which you want to buy, and regardless of whether you are there or not, it will trigger if there is money in your wallet. So that's what you can do. And once you buy the stuff cheap, you can move it off the wallet for the next 18 months, and then sell when it goes back to all time high. It's very simple. Ethereum's all time high was 4,870 something. So it will definitely go back to that all-time high. If you sell at that all-time high and you buy it at 500, that's 10x, easy peasy. But it's a waiting game. That's what I wanted to say. It's a waiting game for Ethereum. Optimism. I talked about optimism last week, and I said I was waiting patiently for it to calm down. You can see that it's starting to calm down. It's done its double top, and it's on the way down. Like I said, I think 1.2 is or 1.1 or 1 is a good price bargain. This trend line is likely to hold. So if it holds, yeah, 1.1 will be a very good bargain. Uh, but optimism is going to do a lot of stuff in the coming bull run. I'm gonna try to do the research on the number of AI tokens that are being pandered around, and because there's been a lot of interest in AI like ChatGPT and the likes in recent time, people are going to start creating. People are going to start creating crypto and calling them AI something GPT. There's already one called GPT. So people are going to start creating crypto tokens and tagging them to AI. Many of those tokens are not going to have functionalities, by the way, because they won't have a product. They'll be selling on the promise of the product. But you could get, I mean, you could make a lot of money off them, anyways. But I mean, they're not. They might not last beyond the next bull run. But keep your eyes peeled. If you see anyone, let me know as well. I'll do a further research on them. I'll tell you what my opinion is. But that's what I think is going to happen. There's going to be a lot of shilling of AI related tokens, crypto tokens in the season to come. Mostly because there's so much fraud around right now. So many of the traditional tokens might not be catching on. So making tokens that are AI, centric or AI philic is going to make a lot of buzz and generate a lot of interests. I think that will be the end for today. If you do have any other questions, let's have them before we call it a day and let you have a nice weekend. Um, yeah, Bam Bam. I know about smart AI. I know I've seen a number of them as well. I'm just watching them from afar. It's so there is there are a few fundamental schools of philosophy or philosophical schools. Let me use that word or philosophical positions in the crypto market. There are the big money bags who are secretly participating and making money from crypto, but don't want people to know and don't want anyone in, like the Goldman Sachs of this world, JP Morgans of this world. We have people like that. They're the big money movers. With them are the hedge funds, the investment banks, the crypto hedge funds as well. That are making huge tons of money from crypto, but usually they'll buy when everything is flat and sell at the peak of the market. Then you have the techies, who are the guys that are developing. These guys are just techies. They just like to build stuff. They write code, build products. And then you have the marketers. These ones, they're not building anything. They don't have much money. They're just chilling. They create communities. Uh, they help the developers to market their coins. They get tokens for their services, and then they come and shill it on social media, and people get it. And if it's a completely pump and dump, they dump on everybody at the end of the day. If it's not completely pump and dump, and it's some guy or guys trying to build a product, depending on how the product fares up until the bull run, it might become big, like Solana or BNB, or might fall flat on its face and disappear into thin air. So what I've observed from 2020, 2013 is that each bull run has an underpinning theme. And that theme is what drives traffic and drives interest and drives funds into it. It's almost like the tech guys sit down like, okay, what exactly are we going to do now? what's in mainstream tech that we can plug into blockchain and make this, attractive. In 2013, it was ICOs, and there was so much ICOs in 2013. That was what drove the price of Bitcoin to all-time high in 2013. In 2017, it was the era of big centralized exchanges. It was the era of tokenization. There was a lot of talk about tokenization. Um, that was when the talks of DApps, decentralized applications, started. But and DAOs, the decentralized autonomous organization. But it didn't quite until the last bull run, during which Uniswap launched. There was a lot of talks about decentralized exchanges, mega talks about decentralized applications and all sort of decentralized economy, decentralized finance, DeFi. Then Metaverse came. There was a huge buzz on Metaverse, and of course, on the back of that, so many things rose like meme coins and all that. So usually there's something that is driving the bull run. So I suspect it to be AI that will be driving this coming bull run. So yes, I'll keep my eyes peeled for the AI token or AI centric tokens. Have a lovely weekend, everyone, and hope to see you again next week by God's grace. Bye.
Bye. Thank you.
Cheers.